let's begin with the impact of the next U.S. president. Does a President Harris or a President Trump matter much in terms of what you expect to unfold with deficit spending, the markets, the economy over the next few years? Or do you expect the markets and economy to go through a specific cycle regardless of who is president? And what would the characteristics of that cycle look like to you?
Yeah, it's certainly a timely question now with everyone, certainly in the U.S., but frankly around the world, watching carefully at this circus in American politics, from the debate to an assassination attempt to a dropout and now a new Democratic nominee. Obviously, people have very polarized views on this. I tend more towards the conservative bend, but regardless of biases on politics, I said recently in another conversation, and I mean this with all due respect, it doesn't almost matter whether it's Santa Claus in the White House. I almost feel sorry for the next president, unless they're very blunt about our macro conditions, our debt situation, and our bond markets. It's very, very hard to imagine how anyone can solve this problem, left or right, blue or red, male or female, woke or base, given the fact that unless a president, left or right, blue or red, Republican or Democrat, is willing to make massive spending cuts on deficits, entitlements, and military, there is no other way to support that debt. And other than more lend and spend, or extend and pretend, which is to issue more IOUs, of which the world is less and less in love with, and then monetize that delta or that gap with some form of synthetic liquidity. That doesn't have to be direct QE. It can come from the TGA, it can come from the reverse repo, it can come from supplementary leverage ratios. There's all kinds of tricks to create liquidity that aren't direct QE. You can have the big banks do QE for the Fed, but it's just off the balance sheet, but it's still QE. In other words, more currency debasement, more debt to solve a debt problem. And again, I feel sorry for whoever gets elected in November and jumps in January, because like I said, Mother Teresa, Papa Smurf, Santa Claus can't solve the debt crisis which generations have given us, really. But it would take someone with an immense amount of courage to try and get elected by saying, look, we have a real debt problem. We have a real currency problem. We have a real social problem that all stems from that debt problem, regardless of identity politics, regardless of woke versus based, regardless of your biases. Whenever there is invisible tax like inflation, and whenever you have such compounding inflation over and over, that hurts the soul, pocketbook, and mindset of the average American, the working poor, which I call the new middle class, who are living paycheck to paycheck. So when you have that kind of month-to-month pain and stress, economic, it can show itself in all kinds of other ways: identity politics, race relations, sexuality, transgender bathrooms, swimming teams with men and women, all this stuff can seem like it's the real issue, but the real issue is people are financially stressed. That seems so trite and derivative, but social unrest comes from financial instability, and the financial instability that we've created for decades and is now coming home to roost is going to be a challenge, Gary, for whoever is in the White House. And I'm not trying to be sensational. I really am not. I've given this a lot of thought. I don't see an easy way out for the U.S. in particular, or the global economy in general, given that we're the home of the world reserve currency, given the level of debt we have. Our tax receipts and GDP do not cover that. As even Bank of America will admit, we've got $1.6 trillion in interest expense alone on our IOUs and our U.S. Treasuries. We don't bring that in tax receipts and GDP. Even the GDP growth we have is debt-driven GDP. So it's not, to me, it's an oxymoron. Debt-driven growth is not growth. So however I look at it, and again, not just a gold bug pushing gloom and doom to buy precious metals and pet rocks. If you talk to Jeremy Grantham on the equity side, you talk to Gundlach on the credit side, Ray Dalio, it's not just the precious metals guys anymore that are calling for this very severe warning and caution about the state of our economy, the state of our market, the state of our currency, the state of our government, and clearly the state of our society. I mean, Dalio was talking 50% chance of civil war. So these are not just gold bug extremist things. I really try hard to look at counter arguments and to talk to the smartest guys in the room and asset classes that I'm no longer involved in. I used to be a hedge fund guy. I knew a lot about bonds and spreads and junk and credit and good and corporates and treasuries. I knew a lot about equities. Now I'm looking more at just preserving the wealth that I have. So I have a bias towards physical precious metals or gold. But again, I don't think it's just a gold argument anymore, and it's not sensational. It's very real to talk about these things, and it shouldn't be partisan. It shouldn't even be sovereign versus sovereign. It should be global. But I think we need more transparency, more honesty on the political side when we're delivering the message, and we need to be more realistic on the public side when we're making our votes. To your question about who's in office, but again, realistically, people tend to vote on being promised good news, not bad news. If I were a politician or if I were a Fed official, I'd probably keep promoting the be calm, carry on narrative.
76% of all personal income tax last month went to servicing the trillions of U.S. national debt, according to PhD economist Peter Sadange. Yeah. Hemingway said that that kind of debt will buy you short-term prosperity, but it does lead to some type of permanent ruin. Was Hemingway prescient, and are you anticipating some type of permanent ruin from all of this debt? And if so, how would you describe the ruin that you would be expecting? What is that going to look like?
I think it's a brilliant quote by Hemingway that I've used it a lot in a lot of my articles. I've used it over the years. He said that, whenever there's a nation that's back against a debt wall, you'll get political opportunists promising temporary prosperity, but ultimately delivering permanent ruin in the form of debasing the currency and perpetual war. And again, let's unpack that in a second. Your other point you made in that long, very important question was just in the last 4 years, debt. We've had 11 trillion in new government public debt in the last 4 years. It took us 220 years to get to the first 11 trillion. So it's very important that the way you string cited those facts, because again, they do sound sensational. They sound crazy. The sad fact of the matter is reality is sensational. And believe me, in the gold space, in precious metals, and frankly in Wall Street, whether it's a meme stock in tech or AI, or whether it's gold going to 50,000 next month, there's a lot of sensationalism. But the irony of ironies is you don't have to do anything but recite those facts and then make sure that the audience, as well as ourselves, don't just treat those as abstractions. Trillions no longer matter. I call it the banality of debt. There was a famous Holocaust book by Hannah Arendt about the banality of evil. When you're killing millions of people, it becomes almost unthinkable. So even the horror of it kind of becomes banalized. Well, the debt levels have become banalized because we talk about 33 trillion, 34 trillion, 35 trillion in public debt, or over 100 trillion in combined household, corporate, and public debt. Those numbers are banalized now because they mean nothing. What's a trillion here, a trillion there, 1.7 trillion in interest expense? But if you take the time to look at what that means, that's unsustainable, and that's destructive to the currency. It's destructive to the dollar that you measure your portfolio, your salary, your checking account, your returns. So that goes to the Hemingway quote then. When you have these political opportunists who won't talk the truth about liabilities, expenses, fiscal deficits, twin budget and fiscal deficits that are unpayable and unsustainable, that the only way to do it is to monetize it with fake money, which is debasing money. That leads to what he called the permanent ruin after the temporary prosperity of a market that never seems to go down, and all the good news and all the just fix it with more IOUs. After that temporary prosperity, which benefited the top 10% of Americans, not the bottom 90, then comes the permanent ruin of that inflation, which we all feel, and frankly, permanent war, which we've been either in a direct or proxy war since the day of my birth, from Vietnam to the Ukraine. If you take the time to look at the math and the history, what Hemingway said has been true without exception from ancient Rome to 1990s Yugoslavia to 1789 France to Weimar Germany to Franco Spain, Mussolini's Italy to today, even in the home of the great Iwo Jima, iconic flag, America, and great Hollywood and Clark Gable, and all the great things that we all love about America, from the Yankees to the Red Sox, whatever you say, despite those nostalgic images, we are in a moment of history right now, which is hard to see because we're in it, Gary.
The Fed has been squawking for quite some time, really for several years, about lowering interest rates. Right now, the market's betting that about 90% that the Fed is going to begin to cut rates in September. Mm-hmm. What will it really take for the Fed to initiate a cutting cycle? And what happens to the metals and the commodities in your analysis when they actually do start cutting the rates?
Yeah, I mean, look, I made a prediction in January. Look, there's no one more cynical about the Fed and about these markets and about these bubbles than I am. But I even said in January, it's risk on. When Powell said in late 2023, early 2024, that 2024 looked like a rate cut year. And then in January, they were talking 6 rate cuts. Right. And the markets went galvanic just on the talk of a rate cut. Now we're heading into, the end of the year, closing into the end of the year, summer and the end of the year. It's 95 degrees here, so I'm very hot at the end of the year here. But now we're talking about September cut, and that's what I said in January. So we'll probably get a cut in January, and it won't make a difference. The markets have been galvanic just on the thought of a rate cut. And of course, when the cost of money is a little bit cheaper, that's bullish for the markets. Of course it is. And if they do 3 rate cuts, that's even more bullish for the markets. But it almost doesn't matter because the end game is still going to be inflationary. A rate cut is going to be inflationary. If they stay higher, that's going to be inflationary because the only way to pay that interest is to print more money to cover the interest expense. Either way, you're debasing the dollar. In the near term, in the short term, any rate cut is going to be a tailwind for equities and risk assets. And that will probably lead to some type of more continued euphoria. But again, that's only near term because, again, you're still looking at so much risk in the equity markets. But even then, even if you're getting a slightly 4 or 5% higher return on your portfolio, you're measuring that in increasingly debased dollars. So I think the Fed is trapped whether they cut or go longer. Either way, it leads to an inflationary end game where you're debasing the currency, you're debasing the dollar, you're cutting rates, or if you stay higher for longer, the interest expense becomes so high you have to create more liquidity, which is more debasement. So it's still inflationary. That does not mean, real quickly, that you can't have disinflationary forces in the interim, like a major recession or a market mean reversion if these markets ever go below their mean. Many would argue that they will and can. But again, no matter how you place it, you can buy time, you can buy even more air under this bubble in the equities market, but you're still measuring that with dollars that are weaker. And that's the hardest thing for people to see. They just can't look deeper under the hood of what inflation is doing to it, whether it's at 9% or 3%, Gary.
Are you seeing any signals of a looming banking crisis, either because of the bond portfolios or because of bad commercial real estate loans? And how bad do you anticipate a crisis to become?
Again, this will be sensational. This is a gold bug guy. Got a caveat, but I absolutely see a banking crisis. And what's interesting is, don't take my word for it. Take the Federal Reserve. And when I say the Fed, don't take Jerome Powell or maybe Janet Yellen, the former Fed chair. I was talking and listening to Thomas Hernick, who was the Kansas City president of the Kansas City Fed, one of the few truly honest brokers at the FOMC, who was always trying to veto Yellen or Bernanke, always trying to caution, because what Thomas Hernick was saying when he became a Fed president as a younger man, his mentor said to him, when you make decisions at the Fed, make decisions for the long term, let the short term take care of itself. In other words, allow certain constructive destruction, but think longer term, generationally, what's best for the next generation. The irony is, and excuse me again, I'm sweating in this 95-degree heat. The irony is what the Fed has done is the exact opposite. This is what Hernick was so upset about. This is what he was making a very good point, because what they've done is think only in the short term. Every dip was a buy. Every crisis required more liquidity. Every panic required a rate cut. And so what that did was it gave more fuel to a bubble. It gave more synthetic liquidity, but also created more pent-up kinetic inflation. And so they were not thinking longer term. But what's interesting about what Hernick was saying is, by the way, he was a former bank regulator, an FDIC official before he was at the Fed. So he understands banks and bank balance sheets. And we've all heard about non-performing loans, the commercial real estate side, and these banks, and they're appalling beyond just New York Community Bank and others. It's the too big to fail banks that are sitting on probably $600 billion in underwater U.S. Treasuries under the higher for longer policy. When mark to market, they're negative. But far more important to Hernick, who certainly knows banking better than you and I, and who's being honest and who knows the Fed, he said far more important is the trillions in non-performing loans, many of them commercial real estate loans, that are underwater and not going to get better when they're trying to refi at a higher rate, which is another reason why the Fed will want to reduce rates. But those sick patients are already past the Rubicon of terminally ill. And so you do have a major banking crisis on the horizon. I do not know when. I do not know how. Arguably, a rate cut could help that, give a little relief. A lot of these junk bond or these triple C companies or a lot of these commercial real estate organizations have to refi at some point. They have different maturity dates. There's 740 trillion or billion coming out in this year alone, but another 1.2 trillion next year. But if they have to refi at a higher rate, they can't. They just can't afford it. So they default. If they default, the bank's balance sheets get crippled. But you could argue that these commercial banks are too big to fail. They'll find some backdoor way to bail them out. They'll give them par on their treasuries. They'll give them less regulatory constraints. They'll allow more leverage. But that's just making the investor or the depositor more at risk and not being understanding the real risk that they're in. But to your simple question, again, banking risk is not a sensational topic. It's a reality. Look at the math. Look at Moody's. Look at the default rates they're calling these big banks. Look at what Hernig is saying. A guy who has no force in that race about big banks failing. But because of all these years of short-term thinking, these banks have levered themselves into bad loans, and then the Fed has raised rates in addition to that. It's a perfect storm for these banks. It just
countries
is.
you were talking about de-dollarization. At least 45 countries have trading agreements outside of the dollar.
Yep.
Compared to the overall trade amount, it is 100% on the margins. It's not a ton compared to the overall, but it is still happening. So clearly the dollar is not going to implode or cease to exist anytime soon. That is true. Mm-hmm. But that said, as more and more transactions occur outside of the dollar system, what do you see as the impacts to the economy and to the markets?
It's a very important point. You know, again, even when I wrote how the West was lost 2 years ago, I said this was not going to happen overnight. Just like in 1971, when we went up the gold standard, it didn't kill the dollar overnight. Gold, the U.S. dollar versus a milligram of gold since 1971 has lost 98% in purchasing power. It didn't happen overnight. And the weaponization of the dollar and the de-dollarization that began in earnest in 2022 isn't happening overnight, but it is happening faster than when people, even I realize. 45 nations, doing transactions outside the U.S. dollar, that's a headline. But to your point, it's on the margins. 80% of FX transactions are still in the U.S. dollar. U.S. dollar is still key to the SWIFT account for bank transfers. It's still key to the derivative markets. The U.S. Treasury is still key. It's still part of the petrodollar. So again, the U.S. dollar does not die because we weaponize the dollar against Russia. But what is happening is not that the dollar is being replaced. And there's not going to be a ruble, world reserve currency, or a yuan, world reserve currency, or a real, or a rupee. Of course not. The dollar is still king of liquidity. But as a store of value, it's not sensational to say that no one wants it. As a store of value, the central banks watch what they do, not what they say.
What are the implications and concerns for the everyday person moving forward of this de-dollarization reality?
Yeah, I think it's important to keep a rational, sober mind and keep an open mind without having to pick a camp. I think if you go to the dollar is dead, the U.S. is over, and it's useless, it's going to zero, that's extreme. If you go to the other extreme and say, look, we're the best horse in the glue factory, it's all relative, fiat versus fiat, I still think the dollar is the best. I need to own it. There's no other place I'd rather be. Certainly if I was in Argentina or Turkey and watch what the peso and the lira would do, the dollar is far more important than the local currency. So you can't just poo-poo the dollar as a joke or laud it as immortal. They're both wrong. The dollar is not immortal, and it's not a joke. It's just changing. It's just being repriced. And so to your question, the de-dollarization thing is real because, again, it's the fact that the BIS and that other countries are seen as a tier one reserve asset. There's going to be less and less demand for U.S. dollars and U.S. treasuries in general. If there's less demand, price power of the dollar goes down. Now, there are very smart people like Raoul Paul or Brent Johnson who are, convinced that the DXY is going to go to 150. And I'm not saying they're wrong. I don't agree. I take Jeffrey Grunlack. I think will stay in a 100, 108 DXY range because I think there's just openly less demand for an asset. Who wants to own an asset that can be taken away from you at will or that doesn't hold its purchasing power because of the debt of its sovereign holder? And although the U.S. is still the most important country in the West financially, its IOU doesn't give you as much. It doesn't beat inflation. It's an infinite asset, but it doesn't hold its purchasing power. Whereas gold is now clearly the choice. Again, not to disparage, there are countries like El Salvador notwithstanding, but the major countries of the world and their central banks are not stacking Bitcoin or other cryptos. They're stacking physical gold. It's not a barbarous relic. It's a piece of history, and it always will be. It may not move as quickly or as sexily as Bitcoin, but it also won't tank as fast or disappear as fast as potentially Bitcoin. Again, that may upset the Bitcoin crowd. I think it's a mania, but I could be wrong too. But I do know this. I'm not worried about what gold will do in preserving its purchasing power. And that de-dollarization that you're seeing through the central banks, through the BIS, and frankly, through more and more sophisticated family offices and high net worth investors is just the march of history and math. Currencies are debased, to Hemingway's point. And people that don't want to be in permanent ruin have to think about wealth preservation, not just wealth enhancement. And ironically, gold has been doing both. It's increasing in value. It's outperforming optionality-wise the S&P, but it's also preserving your wealth better. And the de-dollarization is undeniable. It's not a debate. It doesn't, though, go so to the extreme where America disappears or the dollar is no longer key. It will always be an important asset. I absolutely agree with that. I just don't think it's going to 150.
Are conditions becoming favorable again for another unforeseen event to severely rattle markets, the economy, the faith of consumers everywhere in the current financial structure?
Well, yeah. I mean, what's the last good narrative we have right now in the U.S.? I mean, think about it. It's our S&P, it's our NVIDIA, it's our tech, it's AI, it's the new meme. It was the .com meme before that. It was the real estate meme before that. I'm not saying AI isn't important or microchips aren't important or that AI and chat GDP isn't going to change things, but the idea that technology is going to make up and fill the gap for all the sins of spending beyond our means, that permanent ruin that Hemingway warned about, the idea that that's going to be enough to fill the gap, I think is naive. I think it's political. I think it buys time. It buys hope. Markets are psychological. In many ways, that seismic shift that you're worrying about, that turning point, is already happening. It's happening in the fracturing of our society. It's happening in the layoffs and the bankruptcies and the corporate bankruptcies and the poverty rates. It's happening in our social unrest. It's happening in our political distrust. It's happening in our distrust of the fourth estate. It's all around us. What's keeping us afloat right now is hope that the S&P will save you, or that we're still the greatest stock market on earth. We're not the greatest manufacturer like we were after World War II. We're the greatest outsourcer. We're not the greatest creditor. We're the greatest debtor. So you have to look at this objectively. In a lot of ways, we're already there. But I think even Hernig said the only thing keeping us from oblivion is a banking crisis. The only thing keeping a banking crisis alive is time. And so when we have a market crisis, and it will probably be led by a banking crisis or a mean reversion, you're going to see QE to the moon. That's going to look like a solution, but that's going to mean be careful what you ask for, because that's simply at the expense of your currency. And that's why gold isn't, to me, an argument or a debate. It's common sense. And the efforts the banks have made and the Wall Street crowd have made, because they have a vested interest in not seeing gold rise, because they can't profit off trading it, they can't churn it, and they certainly don't want to see the dollar get too embarrassed. So it's not part of the mainstream narrative. It's not part of the headlines. But in the contrarian informed community, and the very intelligent high net worth community, and the family office community, and even obviously in the central bank community in the East, it's a no-brainer. And what's interesting, Gary, is, you know, the 40-year mean for gold allocations is like zero. It's 2% allocation out of a whole portfolio. That's nothing. But right now, the current allocation is 0.5%. So just a reversion to the mean in gold to a 2% sends the gold price up significantly higher. Or if we go to 5 or 6%, even higher. So even in terms of price moves, gold goes higher just by mean reversion. But the fundamentals are all there for gold to go higher. But again, when gold's at 5,000 or 10,000, a cost of a loaf of bread or a tire for your car or your child's tuition is going to be much higher too. So it doesn't mean that the gold makes you rich, but it keeps you from getting poor. That's the only thing you can do in the long run. And to me, that's good enough. But that's not often good to hear from people that are going further and further on the risk branch, just trying to make some money right now, trying to get by because they feel so trapped. I understand that, but I think they're misallocating their thinking to what's more important: preserving your wealth or losing your wealth or risking your wealth. And to me, again, yeah, I'm a gold bug, but to me, it's common sense.
Who gets hurt the most here as these things play out?
Mean reversion in the market means a much lower S&P, Dow, and NASDAQ, which kills the pension funds. It certainly kills those that are taking, you know, their retirement in the account, and they think that their IRA is going to be the same as it was 10 years from now, as it was 10 years ago. So that hurts the middle class and the working poor the most. The top 10%, which owns most of the S&P wealth, will get stapled a little bit. They'll get gut punched, but they won't be ruined. The real losers here is the average citizen, the average American, because of the purchasing power of their currency. So the mean reversion of the markets, the mean reversion of the dollar down because it's so overproduced, over synthetically created and debased, that is clearly for the man on the street. And even for the wealthy, those that don't have gold are going to get, I think, spanked even more. And you could argue that this time is different. The S&P will never fail. Despite 2 sigma moves off of its mean, you could argue that. But I think what this means is a lot more of that permanent ruin that you opened up with Hemingway in the beginning to come. And that sounds no fun at a party. That sounds gloom and doom. That sounds negative. I get it. It's depressing. There are things you can do. Gold, I think, is one of them. You could find other real assets that hold their value more than currencies, or overinflated S&P or an overinflated NASDAQ or Dow, or certainly a completely respirator credit market. I mean, Gundlach said you'd have to be an idiot to buy treasuries when you look at real inflation, because you're literally losing money. That's Gundlach. That's not a gold bug. So again, mean reversion in equities is dangerous. Mean reversion in stocks and bonds are both dangerous. And mean reversion in precious metals is going up. If you're playing where I say the polo ball or the hockey puck is headed, You follow it where it's headed, not where it's sitting now. And it doesn't mean gold goes in a straight line, but it will certainly do better than those other highly volatile, highly overvalued and inflated asset classes. And it will certainly hold its purchasing power as a store of value better than those as well.
Does the world need a gold-backed currency? And is that what's needed ultimately for the world to move to gold? You've expressed, I don't understand why the message isn't getting through. I don't understand why they're not paying attention. I don't understand why they're not understanding the math. I'm with you in that camp, but what's needed for the world to move to gold, and does the world need a gold-backed currency again in some shape or form?
Yeah, you could argue. I think it's highly unlikely that it will go to a gold-backed dollar again. Although you could argue the Heritage Foundation is talking about getting rid of the Fed too, and getting rid of the Federal Reserve, and getting back to a chaperone currency with a gold backing or gold coverage. That's a speculation I'm not willing to make. I think it'd be very hard to do. For one thing, I think governments, including the BRICS, don't want to have a gold-backed BRICS currency, or the U.S. doesn't want a gold-backed dollar, because that limits the ability of these sovereign nations to actually create more money at will when their backs against the debt wall. So they want the flexibility to base their currency, being realistic. But what happens is, I think, especially in the BRICS, is what I've been arguing for the last few years, is you don't need a gold-backed BRIC currency. You just need to net settle your trades in gold. That way, for example, Russia and China is a classic example. Russia has a lot of oil, and China needs it, right? So, but China doesn't want to buy oil in U.S. dollars, so they'll buy it from Russia, and they'll pay for that in yuan. So Russia will take the yuan, and they'll use that yuan, and they'll use it to buy a lot of things in China that were, by the way, once made in America. And whatever the difference is in the currency, they'll net settle that in gold. And by the way, India can do the same thing. Brazil can do the same thing. They're using gold to net settle trades. It is a chaperone unofficial. It's an unofficial gold-backed trading settlement currency. It doesn't have to be a BRICS, Glassiev, Bulbakov, idea of a BRICS gold-backed currency. To Rick Rule's point, I said this in a conference a couple years ago. We both agree. I don't think any country wants to give up its right to debase its currency. But while they're settling trades at the current valuation in real assets, they'll net settle that in gold. And that explains why the central banks in the East are stacking gold at record levels, because that's where they get their credibility. Now, yes, you could argue that the US dollar, or a major currency, to get back to normal, has to have some type of gold coverage. I think that's hard to foresee in the next 5 to 10 years. It would take a major mistake, a major crisis, but I think the next crisis will be solved not by going back to sound money, which is what you should do. Next crisis will be solved by blaming it on somebody else, on little green men from Mars, global warming, which I'm feeling today, COVID, whatever. You'll blame it on something else, and then you'll print more money, create more debased currencies, solve another debt crisis with more debt, and monetize that at the expense of your currency. It's inflate or die. That is more realistic to me than going to sound money with gold-backed currencies, because that limits the sovereign's ability to increase their debt levels and screw the people.
There's been talk for a while now, the last several years, of a commodities super cycle. It's been quite the hot topic, really, since their bottom in 2020.
Yeah,
commodities have certainly shot higher since then. However, their returns are nothing like NVIDIA and other growth plays. It's just not even close.
Yeah.
Do you see a commodity super cycle forming, and what data leads you to the conclusion? Or is it even outside of data? Is it more, perceptual?
Well, I lean on Ronnie Sturfula, an Austrian economist who has a fund called Incrementum out of Liechtenstein. He's an advisor to von Greyerz. He writes the In Gold We Trust report. He's brilliant. And he came out with a chart last year. He called it the chart of the decade, which was just the commodity super cycle, the S&P versus real assets. And it looks like an EKG, up and down, up and down. And you basically see these long periods where the S&P is ripping and commodities as an index are getting clobbered. And then it reverses. And then the S&P is getting clobbered and commodities are ripping. And again, it goes back to my point earlier, is playing where that hockey puck is going to be, not where it sits. And again, it's hard. The opportunity cost of getting on NVIDIA or Bitcoin or some tech stock du jour right now is very hard when you're going into an unsexy commodity play. Yet if you're playing 10 years out, you want to do what everyone says they do, but no one does, which is buy low and sell high. Everyone right now is chasing tops. That said, for a commodity super cycle to be believable, though, if we have a recession in the interim, well, that affects commodity prices too. So it can be a long time before commodities as an asset class, as a whole asset class, start to really get their tailwind. And so there's a lot of caution. There's a lot of out of sight, out of mind. There's a lot of skepticism. But again, it depends on what kind of investor you are. If you're a speculator trying to get some easy lottery ticket, respect that, take your risks, have your eyes wide open. If you're a longer term investor playing the long game, like Beatty and Rule and myself and Egon, we make 10-year decisions, not 10-month Twitter decisions. But that's not, again, trying to be flippant, but you got to think, what's your personality, what's your need, what's your profile? When you see something cheap, it's going to be necessary, you buy it. When I saw oil go down, I didn't need to be an oil expert. You just buy it. Even as negative as I was on the stock market, when we had that temporary crash in March of 2020 during COVID, and when the Fed announced unlimited QE, as disgusted as I was by that decision, I was pedal to the metal long equities because they're giving you a fat pitch. Mm-hmm. In terms of an equity or commodity super cycle, it's inevitable. Can I time it? Absolutely not. Can I see what'll signal it? Yeah, when net income margins on the big tech stocks go down instead of north. Just watch the net income margins. Watch when they consistently go from north to slowly south, like Lucent did, like Amazon did, like Commerce One did in the 90s or the dot-com bubble. If you know how to trade and you know what to look at, you can see when those cycles begin. I can't say it'll be November 27th, 2025. I don't know. I know what to look for. And if you do, great. If you don't, you got to do your homework. Get informed. Listen to me. Listen to people who disagree with me. Listen to you. Listen to people who disagree with you. Get informed. Again, I'm quoting Rick Rule because he says it better than me. The best investment you can make, as Pollyannish as this sound, is an investment in yourself. Mm-hmm. Learn. Be skeptical. Be skeptical of gold. Be skeptical of Bitcoin. Be skeptical of the dollar. Be pro-dollar. I think the more you look at history and math and market cycles, for more than just a couple hours on YouTube, the more you take notes, write this down, track it down, listen to people that are experts in their field, whether it's Jeremy Grantham or Jeffrey Gundlach or Bill Gross or Ray Dalio or me or Egon or Ronnie or whoever in their respective classes, you'll see a lot of consistent overlap. We're not trying to spread sensations. We're trying to spread common sense. It's very important to get informed. That's free. That's free.
Well, folks, that was worth the price of admission right there. That answer to that question, that was spectacular.
I don't see Bitcoin dying tomorrow either. But again, it's not Bitcoin or gold. I just don't see a scenario. When I look at what nations and central banks are doing and what countries are doing with gold, not necessarily what the guy in the street is doing with gold, or not even what BlackRock is doing with gold, but what the world is doing with gold, I can't help but be bullish. And I don't want to mislead people, but I'm almost too bullish. It's the asset class that I believe in. Egon, my partner, started buying gold, and everyone laughed at him at $200 or $300. And he put most of his assets into gold. He eats what he says. He eats his own cooking. The kind of wealth he's made just on price appreciation is extraordinary. But more importantly, the conviction he had that no one understood 20 plus years ago. It's not that he's getting the last laugh. It was just he was contrarian with information, not emotion. Contrarian with the facts, contrarian not just with what the market was not saying, but what history taught us and teaches us all about what governments, to Hemingway's point, do to currency, how they create permanent ruin, and how they blame it on everyone else but themselves. And that's exactly what we're seeing right now. Exactly what we're seeing.